Okay, so let's go over the second week of this case study. So, case study proving what we've gone through pretty much since the start of the year, and that risk models is what trading is all about. Putting a lot of focus on a fairly standard or an entry that's fairly consistent, and having putting a lot of time and effort in towards the exit strategies and the overall management of the system. The risk models. What I found, you can probably vouch for this, Kath, and myself as well. When I first started trading, and for a long time, it took me a long time to really understand this, well over a year, um, that it's not all about the entries. It just used to be so much of a focus on entries, getting that strike rate perfect or getting the entries perfect, and just everything was about the entry. Yet there was very little done about the exits and about the complete management of a system. So that's a big downfall in as far as retail trading in general, because people just want to hear about systems and what's the best way to get in a market, but it's not a profitable way to trade. And then you sort of look in behind the scenes and look at what the professionals do, and there's a lot of a different situation going on. And basically, many traders have said, I read it in many books, and I firmly believe it too. And that's the whole basis of this case study, is that you can take any systematic entry, a simple entry, and sometimes the simpler the better. We've spoken about just the first PowerPoint or the second PowerPoint, or just having taken the same spot time in, time out, but then really focusing on an exit strategy and focusing on creating the systems around that in regards to drawdown and position sizing, and focusing on just making profits year in, year out, and compounding that. Once you start to focus on all that sort of thing, that's when everything really can start to fall into place. So this week, just a quick overview of last week. Basically, week one last week, we introduced the case study. We looked at January's results in R multiples. So it's very important that we do everything in R multiples and look at this expectancy. So it's not just strike rate, it's expectancy and drawdown periods. And obviously we'll really start to focus on putting systems together and what kind of position sizing and what sort of drawdown, how that affects the model. We'll look at that in the fourth week, but for now, it's just we introduced it last week, this week, and next week. So week 2 and week 3, really just going through some results, and straight up you can start to see some real consistency within the results and some patterns starting to form. And that's before we even create a model around that. It's just raw data. You can see from the raw data some really interesting things. But obviously, then you take that sort of raw data, and then in that fourth week, create a system around that. Add in some indicators, add in some perimeters, and look at obviously from that we just want to all that is to get better expectancy, increase the expectancy, and limit drawdown. That's my two biggest focus within trading, is better the expectancy, obviously that's what we're after, and limiting that drawdown, and make sure we get position sizing right, so that at the end of the year, at the end of 12 months, it's all about getting that profit at the end of 12 months. And really probably should look at in that week 4 too, compounding interest methods and things like that, where even just the smallest amount. I mean, I've been seeing a little bit about it lately, because we're putting together this a few models for David's new company, this E-minis Investor, this passive cash flow strategy, or this investment fund that he's about to start. And we put together some compounding interest models as far as just making 5% or 10% a year, and you compound that. Man, it's so powerful. It's amazing what the power within compounding interest is doing, the little things day in, day out. Let alone if you start to aim for 20-30% per annum, or imagine if you start hitting 40-50% per annum. That calculations on that over 1 year, then 5 years, 10 years, 20 years, it's just mind-boggling. It really is. So I think obviously tonight, or this case study, we're really focusing on just an automatic entry. So it has a lot of benefits from that. Really the main thing is taking emotions out of it and really being able to back test. So that's a big vital key to success. So we can really create really strong risk models around what we're trading. And personally that's how important that is now. And you've seen that firsthand. And then once we back test something, you find something that has a lot of potential. It's all about forward testing it, or working your way into it and gradually building up and building the model as you move along. And as the process is just a couple of 5 entries, a couple of different exits, but just taking the data and then creating a risk model around that. So let's have a look at some data. So we'll look at here is going to look at, last week we looked at January. Just look at the raw data from February, March, April, May, June. And then there's a summary tab at the end here. The summary tab will make the most sense because we'll be able to compare and see what's happened over the last 6 months from January to June, and look at what the different what's happening within the different entries. So as in, there's 5 different entries here, and then what's happening over the different exits, and that's what that's the most interesting part, is what happens with an 8, because an 8 tick exit compared to a 10 tick exit, then we've got 12 tick, 15 tick, a 24 tick exit, and then a trailing stop exits. And obviously there's so many, and there's everything in between, and so many different exits. There's so many potential for different entries. I mean, we haven't even looked at, someone might want to have some entries based on going halfway through the market, starting in the afternoon session. You might want to look at end of the day. I mean, I've just purely looked at the beginning of the day. That's what suits me. But there's just a million different ways we can do it, as long as it's very systematic, automatic, and also create those really strong risk models. Any reason why I chose 15 ticks over 16? I just thought, because what I went from 8 to 10, so that's a 2 tick increase, then from 10 to 12, another 2 tick increase. So going from 12 to 16, I just thought that was just too much of a jump. And I've seen a lot of trades go around that 16, 15 tick mark as well. So I dropped it a tick, just thinking that it was just going to be a little bit more reasonable. Wasn't that as big a jump? I just didn't want a big jump, because all the others went up by 2 ticks, and all of a sudden a 4 tick jump would really put a bit of it'd affect the results a little bit. So I just wanted to have sort of 4 exits, and obviously the 24 one, I want to have a bit of a bigger stop. That's sort of another category again. And then the trailing stop, which you know all about, is again, it's another category. So it's like 3 different categories. I wanted some short stops, a longer stop, a trailing stop. But within those short stops, I wanted to take a lot of information there as well. I just didn't want that big gap from 12 to 16. Righto, so February here. I guess there's not a lot of use in just going through each individual bit of data here, because it won't tend to make a lot of sense now, but I'll just quickly go through it. Sort of down the bottom here, I've added in, which there wasn't here last week, commission. So sort of at the bottom here, we've got the first row is the net result. Then we got the result when you add in commission. So I've just taken every 2.5 trades, you take off 1 tick. So basically every month there's about 20 trades. So what that is 2 points, or 8 ticks. I've just minus 8 ticks from every subtotal to give us our total with commission taken out. And then the R value, which is obviously very important. So what did we make or lose in regards to what we're prepared to risk? So here, negative 57 ticks, which is nearly 15 points in this particular one. It's a negative 11.4. So we lost 11 times what we risk per trade. So if you risk 1% of your capital per trade, that's 11% loss for the month. If you risk 1/4% of your capital, roughly that's about a 3% loss. If you risk 5% per trade, you're looking at you're losing half your count in 1 month there. So that's really important to work everything out in R values. And then the strike rate as well. I mean, at the end of the day, you put a lot less emphasis on this, the strike rate or the reliability of the system. I mean, it doesn't really mean much at all. What really matters is the expectancy. What do you make after winners and losers, and we work it all out. What do you make per trade? And obviously you want to be making a little bit per trade when you average it all out. Can't win every trade, but even, I'd much rather have something that wins 10% of the time, but works out that you make a little bit per average trade. Whereas something that has, there's systems out there that have high strike rates, 60, 70%, yet they don't make money because their expectancy is just too low. They have, when the winning trades are there, they might be little, but when they have losers, they might be big. So strike rate certainly only a very small part of what we're talking about here, and I put the most emphasis on that. So this particular one here, actually, wait. Actually, what I'll do is I'll flick straight through to the summary. That's going to be the best thing. There's probably not a lot of use just looking at the individual results. Actually, I will flick through it quickly just so you can see that. Yeah, something like the power fade, it's showing that, and when we look at the summary, you'll see this, that the power fade, the first power fade of the day, it's a very tough one. It has really low strike rates. Even whether you're going for 8 ticks, 10 ticks, 12 ticks, it really struggles. The market seems to always be turning, and from that, a pretty good summary can be made that well, the first terminator is going to work well because the power fades have quite a high rate of failure. We take the opposite of that, which is the terminator. It tends to work quite well. So a lot of red within the first power fade. One that's proving to be working quite well is the first PowerPoint and the first terminator of the day. So obviously they're very similar areas, but they work really well. And just as far as the months go down the bottom here too, so we went through January, February, March, and you'll sort of see this in the summary tab in a second, but January, February, March was, if you remember, there was very slow months within the year, very tight markets. So obviously this is what I want to look into in week 4, is having some sort of indicator that comes over the top that sort of looks at what to do with tighter months and what to do with months where the market moves a bit more. And that's where you can obviously change your exit strategies as well. So January, February, March, very much tighter months, and then April, May, June, because we're just looking at the first 6 months so far. Those months certainly moved a lot more. So let's have a look at the summary now of the last 6 months. Okay, so just to help you guys get a bit of a bearing of what we've done here. So we've got January to June today, this week. We'll do the remaining months of the year next week. So up the top here you can see January, February through to June. You got the frequency. So in January there was 15 trades. So basically that's just trading days. The only days we don't do it is when it's a bank holiday. So obviously apart from that, every day there's one trade because we're taking a very systematic entry, standard entry. So 15 trades, 20 trades, 22 trades, all the way up to June there, 20 trades overall, right up the top corner here at the moment. We're up to 119 trades. So as we add in the months, all these figures will update themselves. And then we're looking at each particular entry, so the 5 entries. So we've got first power fade, first PowerPoint going down, go through the 5 different entries. And then within each particular entry, we've got the different exits. So you can see the 8 tick, 10 tick, 12 tick, 15 tick stop. So consider those shorter to medium term stops. So we're looking at nearly a 2-to-1 ratio, all the way here to up to a 3-to-1 ratio. And then we're looking at a bigger trade, 24 ticks. So looking at more like a 4-5-to-1 ratio trade. And then a different kind of stop again with a trailing stop where you basically trail 4 points. So that gives you an opportunity. You're going to get lower strike rate, but when the market just goes and goes, you give it potential to really keep going, and you're following the market by 4 points. Hopefully, if it just wants to keep going, you have potential for an unlimited gain, really. So some potential for some massive R trades, but with massive R trades comes lower reliability or lower strike rate. And that's really the balance between what you are comfortable with as a trader. We spoke a lot about last week what suits your personality, what suits your style, what suits your circumstances, your capital, everything. You got to consider all areas of your life and the way you like to approach trading as to what suits you. So up the top here, an 8 tick stop, obviously something like that, or sorry, an 8 tick profit target. Something like that it's going to be the opposite to the sort of these ones down here. You're going to have higher reliability, higher strike rate, but expectancy will drop a little bit. But obviously, then you take that raw data, and from that you can say, well, one's not necessarily more profitable than the other. You let the information tell you what's going to be more profitable and what's going to work. Okay, so then over here on the far corner, so this is the total column. So basically got the total percentage or strike rate. So let's look at the first power fade, 8 ticks. It strikes at about 32%. So whether it's a break-even trade or one of those trades where you get 1 tick all the way up to its profit target, it's getting it right 32% of the time. The expectancy of this one, it's in ticks, was 1.8, negative 1.8. So that means for every trade, it was on average losing just about 2 ticks. This is all after commission as well. So obviously, that's not the sort of thing you want to see, is where you're on average you're losing nearly 2 ticks. And then the total points for that particular period from January to June was negative 53 points. Again, it's all after commission. Okay, so I guess the main thing we want to focus on is this column here, and I'll go through it now, and then we'll make a few little judgments or a few little analyze the data just for a little bit. And of course it's just raw data, but where the real focus of the analyzing this data or looking at a few things will be in a couple of weeks time when we start putting it all into a system. So of all the 5 systems, the first power fade, probably one of the worst. You look at it across the board from 8 ticks down to the 24 tick profit to a trailing profit, like on average it's losing 50-60 points. Look at that, it's an absolute shocker. So like we said before we even started the case study, we said, well, let's take any sort of data and you can manipulate it. So if you see something that bad, what's that tell you? Well, take the opposite of it, and you should be, it gives yourself a start. And that's why I said down here that that's the first terminator is actually the opposite of the first power fade, and we'll get to that in a second. But from that you can see the first power fade, absolute shocker across the board. Doesn't matter whether you're going for 4 points or 2 points. The column is in, sorry, yeah, I have it, hopefully it's not too confusing. Yeah, I've got expectancy needs to be in ticks because it's just a little bit easy to understand, because it's so, most of the time your expectancy is 1, 2, 3 ticks, it's not in points. Whereas, yeah, the actual points, Kath, the actual what it made from January to June, yes, that's in points. Because again, if you put that in ticks, it's going to be hard to understand. So that even though it's one's in ticks, one's in points, it seems a bit weird. It's a lot easier to understand expectancy in ticks and a lot easier to understand profitability in points. Does that make sense? So that's why I've got the 2 variations there. I should really mark that with points to make it very easy to see. But yes, the blue box is in points. Remember that. The expectancy above it is in ticks. Okay, so first power fade, shocker. First PowerPoint, I love this. The first PowerPoint, it makes a lot of sense too. If you sit there and watch the markets, you understand the markets, sort of make sense as to why the first PowerPoint or why the first power fade works or doesn't work. But the first PowerPoint and the first terminator doing very well, and you can see here, first PowerPoint on average, 24 point profit, 36 point profit, 39, 59, 37, 36. It made profit after commission across the board. It's pretty good. It's got an expectancy of anywhere from 1 to 2 ticks across all those different areas. If you sort of go back and look at the months individually, you can see what you got to start looking at now is what's the drawdown. I don't want to see something that's profitable, but there's some big chunks of losing trades, because you've got to really hold your nerve to go through those periods. So something like down here, the 15 tick stop, for example, it's the most profitable row out of them. Look, it's nearly 60 points in profit, but it had one of the biggest losing months. For me, I'm prepared to sacrifice a little bit of profit or a little bit of points if I can really limit drawdown. Because I know that 15 ticks, this 6 months not too bad, but it's going to go through some rocky times. But overall, it should really keep on making profit. Sort of the real happy medium, I reckon, is this 10 to 12 ticks. And another point I want to make here while I'm talking about this one too is sort of the point before. If you take, remembering the first 3 months of the year, and this is where you start applying your systems and start manipulating the raw data. If you need some sort of indicator that tells you where the market's moving. You might have some sort of indicator, which I'm working on at the moment, tells you what sort of market you can expect. And plotting, are we in a slow market, medium market, fast market? And based on where that is with that indicator, you have your appropriate exit strategy. So just a very simple, basic way to look at it, remembering, and we've got in hindsight now, we've already seen the last 6 months, but January, February, March were slower months. April, May, June were a lot wider ranging months. So if you looked at, say, obviously in tighter months, it's less likely the trend. So having that tighter stop, say an 8-tick stop, and then in those months where you're getting more trending markets and you have some sort of indicator that tells you now, okay, now we've swapped over to some better moving markets, let's expand on the exit strategy and go for your 15 ticks. You sort of can add, a combination or a mix of the two strategies, and all of a sudden you're looking at about a 60-point gain, but you really limit the drawdown. So already from this data, you can see a mix, start to mix and match a few things and add a few different areas together, even within just this one particular setup. You can really start to get better results. And even this one here wasn't necessarily better points. I mean, it's 60 points is good. But what it really did is it took the best of both worlds. It had a great points return or a great expectancy, and it really limited the drawdown. Its worst month would have been this one here, 1.5 point loss for the month. For the month. So that's already starting to look at combining a few things. So the first Terminator, it's a similar kind of story. You can see this one here compared to the last one. If I sort of put the two there side by side, just let the projection catch up. The Terminator, if you look at the totals, expectancy and profitable points, it's making 15 to 22, 28. It's about, on average, about 20-point profit there over the 6 months compared to maybe on average 30, 40 with the PowerPoint. But if you have a look over here, there's a little bit less, especially up the top here with the tighter stop areas, there's less drawdown. You can see with 8, 10 and 12 tick profit targets, this first Terminator, even though the overall profit was smaller, there's not a single losing month. The only time it started to lose is when you're going for those bigger profit targets. Okay, so this is the sort of thing that we can start to look at, and again, it comes back to the individual and your personality and your style. What are you trying to achieve? What are your trading objectives? It's going to be very different structures compared to someone focuses on potential drawdown to someone who is they don't mind about the drawdown. All they're worried about is making profit, and as big as profit as possible. Okay, so it's a couple of different ways to look at it, and obviously different objectives is going to have a completely different approach. And now let me do the next two sort of side by side. So this is sort of your little bit of an area, Kath. This is the second power fade and the second Terminator. So after you hit a power point, once you hit a power point, taking the very next entry as far as power fade, or the opposite to that is Terminator. Okay, so from this one, let's sort of go to your area there, Kath. It's 4-point trailing stop. So it would have been 26 points after commission with the power fade over all those months, and 25-point loss over all those months. So if you had blended the two strategies together, as in take half one way and half the other, sort of give yourself 2 bites of cherry, so to speak, you would have ended up about break even for that particular 6 months. But I know for the next 6 months, or up to where we are so far, it actually gets a lot better, and that strategy actually comes quite good in these next months, which we'll see next week. But that's sort of a bit of a way to, that's sort of what we spoke about a few weeks ago, Kath, blending strategies together. But even off the top there, it's sort of, it's about break even, but there is a couple of things you can do to make it work a little bit better, which we can look at. And then sort of these ones here. It's that second power fade. Again, it struggles a little bit. It had out of the only time it really got profitable was when you had the 4 point trailing stop on it. So what's that say? It says it really needs those. It's the sort of trade set up that you need to let it run and get some bigger profits. So this one worked out profitable because it was getting some of those big trades and that was sort of saving it. Whereas when you just lock in the profit and do those little profit targets, it was getting its strike rate was just too low to make it profitable. And then it's the same sort of thing for the second terminator. The next one down, it's most of the short stops or the fixed stops or fixed profit targets aren't really profitable. And in this particular case, even the 4 point trailing stop is not profitable. But like I said before, I can tell you now that actually it went through a real purple patch through July, August, September, October. It actually got some really good R value there through there. So it actually, if you're looking at purely just the Terminator from January to now, top of the head, I think it'd make up all those 25 points and actually be back into profit. And but anyway, we'll look at blending possibly the two of them and what would happen once we get all the data after next week. Anyway, guys, so that's week 2. Looking at the data. Hopefully from that you can already start to see some things starting to pop out and something that might interest you. And like we said last week when we introduced this case study, the focus of this is not necessarily to encourage you to take these specific trades, but to say, well, if you take the time to do some study and work out some things, you'll find some amazing data in there, and you can create a system out of anything. You just got to find something that suits you and take a an entry that you have faith in or believe in, and that thing could possibly work. And then it's just about doing the work and transforming that data into something that becomes a complete trading system. But anyway, that's the first part of the raw data from January to June, and just looking at that summary sheet. We'll complete the rest of the data next week. And then the sort of the really exciting part is when you start putting it all together and creating some strategies, adding some few extras like some indicators, and really making something that has a lot of potential. I just noticed I think the projections dropped out there, so no, it's right. But anyway, guys, that's it for this week, and we'll be back next week with week 3 of the case study. Have a great night.